Hello, everybody. I'm Keith Phillips. I'm the CEO and president of Piedmont Lithium. We're a Nasdaq-listed company. Ticker is PLL. We are developing what we believe will be the world's lowest cost lithium hydroxide business right here in the U.S. in North Carolina. And I'm going to go through the executive summary of our presentation today, and I look forward to taking your questions at the end of the presentation. So on page 2, it's headed low-cost lithium hydroxide in the USA. So there's 6 key points for our story. Number 1, we're going to produce lithium hydroxide, and we're going to do it entirely outside of China. In fact, we're going to do it in the United States. We're an integrated hard rock to hydroxide business, again, entirely outside of China, which is important in our view to develop our business. We have an ideal location. We're located in North Carolina, where most of the world's lithium was produced from the 1950s to the 1980s. There are still 2 very large lithium chemical plants there now. There's 60 plus years of processing experience of lithium in North Carolina. That's unique. It's really the epicenter of lithium processing in the English-speaking world. We have superior mineralogy. So this is important. It's a little subtle. There are lots of interesting spodumene deposits in the world with different grades and qualities. But importantly, we believe we have one of the only pure spodumene projects. I'll talk to you about that more. That'll really help enhance our economics. The project is large and low cost. Over the last year or so, we've done a lot of drilling to upsize the resource. So we now have a 27.9 million ton resource. That'll support a 25-year mine life, which is long. And the economics are fantastic, largely because of our location. We'll have very low operating costs, and I'll walk through that in detail. There are a couple of very important near-term catalysts. We're well advanced in the federal permitting process for our mine and concentrate operation. We're optimistic we'll receive that permit this year. That's very important. It's critical from many perspectives, and we feel good about that. We've worked hard. Our team has done a great job on the permitting side. And we're also engaged in some important discussions with potential customers for customer offtake and potential strategic investment. Those are going well as well. I can talk more about that during Q&A. And finally, I think the stock is very cheap. We're trading at about 5% of our NPV, which is a massive discount. And there was a deal that was recent, or that's been concluded actually in the next week or two, a company that's quite comparable to ours it's actually in Australia, a company called Kidman Resources is being acquired at a very substantial premium to our current multiple, and literally 8 or 9 times our multiple. And it's important. I'll talk more about that as well as we go through. So on page 3, the outlook for lithium hydroxide is very, very strong. So as you look at this page, there are 2 graphs. On the left, you see lithium chemical demand from 2018 to 2025. In 2018, the world produced about 280,000 tons of lithium chemicals, mostly lithium carbonate. That's the blue section of the graph. The bright green is lithium hydroxide. That's a smaller market now, but it's faster growing. You need lithium hydroxide for the high nickel chemistry batteries that people like Tesla and VW use to make cars. That's where the real growth is. And that's where we actually expect shortages. If you look at the chart on the left, you see the supply-demand balance. The market's pretty tight right now, but we actually expect shortages by 2023 and very significant shortages of lithium hydroxide in 2024 and 2025, right in our timeline. So that's really important. North Carolina is the leading producer of lithium hydroxide outside of China. The 2 big producers there are Albemarle and Livent, with world-class operations just down the road from our project. And spodumene, the hard rock mineral we'll be mining, is the low-cost source for lithium hydroxide. So we think we're in a perfect segment of the market. There are 400 new EV models scheduled to come to production by 2025. 400. I don't know how many are in existence today, but if you look at the chart on the top right, you see a listing of these. This comes from Bloomberg New Energy Finance. Volkswagen's the world's biggest car company. They've made an $80 billion commitment to the EV space. They're going to bring 80 new electric vehicles in the next 6 or 7 years. This year, they brought the Porsche Taycan, is out now, and the Audi e-tron, and they have some important vehicles to come. But you go through the list. This doesn't even include Tesla or Rivian or some other important American companies. But everyone's moving this way. One of the reasons is there's major requirements in Europe in particular to manage CO2 emissions. And the CO2 penalties in Europe are very significant. They're projected to be $39 billion in the European market alone by 2021. So the car companies are working very hard to get past that. Fiat Chrysler is paying Tesla approximately $2 billion alone in 2019 to deal with these emission issues. So it's a major incentive from their perspective. And importantly, mass market vehicles are coming for the first time. So I'm a Tesla driver. Teslas are great cars. There's some other really wonderful higher end cars in the market now, but we're finally going to see some mass market cars. Ford announced recently they will bring an electric F-150 to market before 2022. The Ford F-150 is the highest selling vehicle in the entire United States. This is fantastic news. Those are big vehicles, big batteries, a lot of lithium. And VW is launching the ID.3, which would be kind of a mass market vehicle. They'll launch that initially in Europe, but they're launching that in 2020. They're building them now. They're going to hit the market in 2020. Again, that'll be a high volume user, and it will be they'll use a lot of lithium, so that's fantastic. Page 5 looks at the lithium pricing environment. There's been a lot of conversation about what's going on in the lithium market. From our perspective, the news is actually generally good. So on the one hand, prices have softened from unsustainably high levels late last year to levels that are very attractive now. We would have very high margins at today's current pricing. And I've broken this graph on the right side. This is battery-grade lithium hydroxide prices over the past 5 years. And you start in kind of period A, the pre-electric vehicle hydroxide market, where prices were $6,000 to $8,000 a ton for a period of time. And then in B, you had real demand from Tesla and other EV producers around the world, including in China. And prices ramped up very significantly, over $22,000 a ton for battery-grade hydroxide. And there were a lot of projects that tried to come into production. Some did come into production in that time frame, particularly Australian hard rock mining projects and Chinese conversion. So they were incentivized to come into production because of that. And prices peaked late last year. Prices have been falling again to levels that are still quite attractive, $13,000 or $14,000 a ton hydroxide. But just in the last several weeks, you've seen massive supply curtailments. Albemarle, the world's biggest lithium company, they're an American company based in Charlotte, down the road from us. They're deferring 125,000 tons of new capacity additions, which were scheduled over the next 5 or 6 years. 125,000 tons in a market that currently is about 300,000 tons. So it's a massive curtailment by them. Tianxi, their partner in Western Australia at the Greenbushes project, is deferring their phase 2 of their conversion plant. And there are a variety of other important delays. These are quite significant. And I think importantly, as you look to the future, you have 35% compound annual growth in hydroxide demand, massive penalties in the EU forcing the car companies there, and lower cost batteries driving cost competitiveness in these cars. And the reality is prices have to be at a level to incentivize new entrants into the market. And we're seeing in this market at 13,000 to 14,000, people are leaving the market. So we're pretty comfortable prices in the long term will be at or above these levels, and that's very attractive to us. On page 6 is a map of the region we're located in. So we believe we're ideally located, and we think we have the best located lithium project in the world. We are 30 miles west of Charlotte. There's a green belt you see in the map. It's the Carolina Tin-Spodumene Belt. That's the only large spodumene belt ever discovered in the United States. There are 2 photos on the left of 2 mines that are no longer active. Livent and Albemarle had mining operations here from the 50s to the 90s. Those were the 2 largest operating mines during that time period. They're very significant. They're no longer operating, but the chemical plants photographed on the right-hand side are still operating. One's in Bessemer City, North Carolina. One's in Kings Mountain, North Carolina. Those are close to us. Those are the 2 biggest lithium chemical plants in North America. And they're just, as you can tell when you look at the map, you see high-speed rail, natural gas pipelines, highways, et cetera. That's very unusual. Most mining operations are located in remote regions where the resources are. In northern Canada, Western Australia, parts of Africa, et cetera. We're very fortunate to be in this particular location. And lithium is a critical material in the U.S. This is important. If you look at the chart, the picture on the left, you see the U.S. represents about 1 or 1.5% of lithium raw material supply today. We do convert more of that in North Carolina, South American brine material. But really, the vast bulk of the upstream production comes from Australia, Chile, and Argentina. Lithium has been identified by the U.S. government as a critical material. And we have the only integrated lithium hydroxide project being under development in the U.S., so that's exciting. You look at the picture on the right-hand side of the page, it's not often understood how much industrial activity and automotive activity, and frankly, lithium activity there is in the southeastern U.S. But we're surrounded by important car plants. Many of those are beginning to make and beginning to be re-engineered for electric vehicles. That's very exciting for us. There are also a couple new battery plants under development in this region. We expect over the next few years, actually, a full supply chain from lithium to cathode to batteries to electric vehicles will develop here in this very important industrial market. We're the only player from raw material to hydroxide in this region. Page 8 really speaks to our position on the cost curve. So the top graph on this page is a cost curve produced by Roskill. They're an important consultancy of London in the industry. And this looks out a few years, and many of these bars represent individual projects. A few are producing currently. Most are projects that are planned to be in production in the future. And you see a few things. Number one, the green bars are hard rock spodumene-based projects, and they tend to be lower cost than brine projects for producing lithium hydroxide, which we'll produce. So that's number one. Number two, the red bars are the Chinese converters. So they're very prominent in this business. They're an important part of the activity, and they're very sophisticated technologically. And China's a big market, but they're also high cost. They have low capital costs and low conversion costs, but they have high raw material input costs because they import most of their material from other regions. So also on this list, you'll see that based on our studies, we will be the lowest cost producer in the world, and that's driven really by our location. If you look at the table on the bottom, and we compare ourselves to other spodumene producers or planned producers in places like Western Australia or Canada, and you think about the inputs into a mining and concentrate plant operation, you need a lot of labor, you need a lot of electricity, diesel, natural gas. You have a product you have to transport to a conversion facility. You have, in some areas, government royalties. We're in a very favorable location. We have 3.5 million people living within a 30-mile drive of our site. We won't need a camp. We won't have to fly labor in to work in our business. People will be driving their own vehicles to our site. Electricity rates are quite competitive. Diesel, natural gas, far lower than Western Australia or Canada. Transport distances will be short. We'll be converting our raw material locally. We won't be shipping it hundreds of miles like some of the other projects do. And we don't have any royalties, any government royalties. We're on private land in North Carolina, so there are no government royalties. So all in, when you add up all those factors, we end up at the left side of the cost curve, which is obviously desirable and where you want to be. Page 9 is just a summary of our updated scoping study. So we did a scoping study last summer of 2018, and we ended up with very strong economics for a 13-year project life. And it was important to us to make the project longer lived. This is a specialty chemical that we'll produce. Customers are interested in long-term sources of supply. 13 years, frankly, was a little marginal. We're now at 25 years. We had 6 rigs drilling earlier this year. We've upgraded our resource from 16 million tons to almost 28 million tons with more potential, we believe. And with that bigger resource base, we now have a 25-year mine life and fantastic economics. On a run rate basis, based on the assumptions in our model, we'll generate almost $300 million of EBITDA per year. The NPV is over $1 billion for US, 34% IRR. And in the table, you can study in more detail. You see how we've improved significantly in really every area. And that's very significant. And I wouldn't say we're finished. We think we have more room to go. Importantly, the project is called a scoping study because we haven't declared reserves yet. We haven't done the infill drilling. But the majority of all the engineering and metallurgy work has been done to a pre-feasibility level. Permitting work has actually been done to a feasibility level. And we're looking forward to advancing this to full feasibility. Page 10, a little bit of a subtle point, but we have pure spodumene mineralogy. I'm not a mineralogist, but what we've learned is there are many minerals that contain lithium. Spodumene is the most prominent, it's the one that people are generally seeking, but there are other important resources in minerals like petalite or lepidolite or zimbaldite. And in fact, these minerals are often commingled. So anecdotally, we've learned that virtually every other lithium project in the world is a hodgepodge to some extent of spodumene, petalite, lepidolite, et cetera, which is fine. But at the end of the day, it makes designing a concentrate plant that much more difficult, and it makes achieving mineral recoveries and metal recoveries more difficult. So we have a pure spodumene ore body. The only other one we're aware of is called Greenbushes in Western Australia. It's the world's biggest, best hard rock lithium deposit. It's a big advantage for us. It'll drive strong recoveries and strong economics for our project. Page 11 is the Kidman case study I referred to. So Kidman is a real success story. It's a great business, similar to ours. Bigger ore body. They own half of it. In our case, we own 100% of ours. And they've been advancing it for a few years. They're probably 6 to 9 months ahead of us in terms of the development. They're being sold. The deal should close in the next week or two to a conglomerate in Western Australia called Wesfarmers for a price of around $525 million US. It's a great outcome for everybody, I believe. So Kidman's a success story. If you look down the left, some of the things they've done well, they attracted SQM as a strategic partner. SQM's a leading lithium producer out of Chile. And they've entered into lithium offtake agreements, lithium hydroxide agreements with Tesla, Mitsui, and LG, three very significant kind of blue chip enterprises. We believe we compare very favorably to Kidman. We have the same strategy. We'll have lower operating costs. We'll have higher annual EBITDA, higher NPV, and higher IRR. And we think we have a unique strategic U.S. location. Their location is terrific, but there are a lot of interesting spodumene projects in Western Australia. We have the only one in the United States. We think that's a big differentiator. The table on the right just highlights some of the important similarities and differences. Again, Kidman's a fantastic project. We hope to achieve a lot of the things they've achieved. If you look at the bottom, you see the relative market caps. Their market cap today is about 525 US. That's what they're being purchased for. Our market cap today is 59 million. It's about 1/9 of theirs. We think there's tremendous upside as we achieve some of the things they have achieved. And then finally on page 12, just a snapshot of our corporate framework. So we're dual listed on the Australian Stock Exchange and on Nasdaq. We're actually an Australian company, but we're all living in New York and North Carolina driving this business. Our our share structure is Australian in nature. We have 815 million shares outstanding. We've listed ADRs on Nasdaq, so each ADR represents 100 ordinary shares. So we have effectively 8.15 million ADRs outstanding in the U.S. Our current market cap is about $56 million US. We have a strong cash position at June 30th, pro forma for our July financing. We have $18 million US in the bank. We're well capitalized for all of our near-term endeavors, and that's great. We have some very strong shareholders. Australian Superannuation Fund is one of the leading investors in all of Australia. They're our biggest shareholder at 13.2%. Fidelity owns 9.1% of our company. They came into our deal in July. Insiders own about 10% of the company. And we have strong research coverage from people like Canaccord and Roth and Foster Stockbroking, et cetera. You can see our board on the right. Ian Middlemas is our chairman. He's a prominent mineral entrepreneur in Australia. It's a very strong board and a strong team. And there's more material in the back you can peruse at your leisure. And with that, I thank you and happy to take your questions.
Okay, we're now going to open up the line for our Q&A session. We have on the line with us today Keith Phillips, President and CEO of Piedmont Lithium. Welcome, Keith.
Thanks. Happy to be here.
Very happy to have you. For our viewers, if you do have a question, just click the question button, and you can type your question in, and we'll get to those as they come in. With that, Keith, our first question, can you provide any insight at all on the stock dropping over the past 5 or 6 months?
I guess it's fair to say it's been a disappointing time in the lithium sector generally for equities. The average pre-producer is down about 75% from January 2018. We're probably down about 55%, so we're a relatively good performer, but the last few months have been difficult. We had a lot of volume in our stock in March, April. We had some good buying out of Australia, out of the U.S., and some other parts of the world, actually. And our stock really outperformed the market from kind of March, April, May. And we did a nice financing in July. We were able to do that at a strong level with good investors. And since then, I think there's been a couple shareholders selling, not huge volume, but without buyers there, the stock's traded off. So it's disappointing. I think it's a really attractive time to be looking at it now.
And our next question, earlier you talked about hitting about a $300 million EBITDA run rate. Can you talk a little bit more about what that run rate means and when you think you might be actually hitting that?
Yeah, so that number really reflects EBITDA when we're fully built out and integrated and operating at full capacity. So our current plans assume that we'll be ramping up our chemical plant over a 4-year period. And the scoping study actually assumes we'll do that. That we'll first do the mining concentrator for a couple of years, then build the chemical plant and ramp that up over about a 4-year period. So we'd really be, in that scenario, hitting run rate EBITDA in year 7 or so. We're shifting our view at this time to plan to accelerate the chemical plant, and our hope is also to be able to accelerate the ramp. The 4 years is very conservative. It was a number imposed on us by our engineering consultants, and we're fine with it, but most other studies assume a 12 to 18-month ramp up, so we would actually hit that 300 million number far sooner. So as we work toward a pre-feasibility study on our chemical plant over the next 6 months or so, we will be refining that analysis, and we'd be hoping to accelerate the realization of that cash flow level.
Our next question, are you pre-selling any of your production?
So we're in contact with a number of parties around the world, both buyers of spodumene concentrate, but more importantly, potential buyers of lithium hydroxide. We fully intend to contract to sell most of our production over probably a 3 to 5 year period to support project financing for the chemical plant. I was actually in Tokyo and Seoul recently, seeing important players in the battery supply chain over there. We're also in touch with a number of parties in the U.S. and in Europe. And I think we will certainly have, we hope, 3 or 4 highly credible offtake partners really contract to buy the material. That may include prepayment, which would help with funding and reduce the need for external capital. But for sure, we'll be locking that down. We've actually signed one MOU now with a party that we haven't disclosed the details of it, but it would represent about a quarter of our production. And we'd hope to continue to work on additional offtake agreements over the next several months.
Very good. Thank you, Keith. And our next question is a somewhat follow-on to that. When do you expect the next major milestone for the company? Will it be an offtake partner or possibly a joint venture?
There's a few things we're focused on right now. Number one is the permitting for the mine and concentrate plant. We do expect to receive our important federal permit this year, so in Q4. So that's an important milestone. The process has gone very well. We're confident of that, but we're kind of waiting for the final resolution of that. We are in conversations with potential offtake parties, so we may have announcements in terms of offtake. I think we have strategic conversations that have been going on over time, but that's less likely to happen in the near term, kind of by design. What we want to do is do the test work in the chemical plant to get to a pre-feasibility stage. What we've done so far is a lot of work on the mine and concentrate plant. We've proven we can make very high quality concentrates with high recoveries, low impurities, etc. We plan to do the same now with the chemical plant, and we'll do that over the next 4 to 6 months up at SGS Lakefield in Canada. And that'll really serve a lot of purposes, both with offtake and with strategic parties.
Very good, Keith. Thank you. And that was actually the last submitted question we had. You covered a lot of information both in the presentation and added some great color here in the Q&A. But just in summary, what's the key takeaway for investors, and why should they take interest today?
I think it's a perfect time to take interest. The lithium equities have been beaten down. Our stock is down since we did our financing by about 35%. But all the fundamentals of the project and the business are actually better than they've ever been. So the project is very robust. We think it's the best located lithium project in the world. We're making good progress on all of our milestones. And I think what we noted in Tokyo and in Seoul in meetings with a number of parties in the battery supply chain is demand for lithium hydroxide is growing just dramatically. Individual buyers need 3 or 4 or 5 times the material 3 or 4 years from now that they're getting today. And it's going to be very difficult for the market to keep up with that. So the time will come where the market will change, the tone will change, and the stocks are going to really run. And I think that'll happen reasonably soon, frankly, certainly in the next 3 to 6 or 9 months. And I think it's a good time to be positioned in the stock.
Very good. Thank you, Keith. And for our viewers, we were just talking with Keith Phillips, President and CEO of Piedmont Lithium. Ticker symbol again on the Nasdaq is PLL. If you're not already signed up, please make sure that you do enter your email address below the presentation window. That'll get you on the news alert list for Piedmont Lithium. That way, as some of these milestones are hit and more announcements are made, you'll be one of the first to get those news announcements. With that, I want to thank everyone for joining us today. Thank you, Keith.
Thank you.